Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to the latest episode of Father-Son Finance. Today, we are going to talk about inflation in regards to the differences of how Main Street sees inflation, so the everyday person, and how Wall Street sees inflation when they're measuring different data points and year over year, and really look at kind of the divergence because there was a while in 2022 where Wall Street and Main Street were on the same page on inflation, but then really right around 2023, we started to see the two kind of go in different directions in terms of sentiment around inflation. So we're going to dive into that. We're going to talk about a few other things, and so let's get right into it.
Sounds good. All right, so first thing we need to do is define inflation and what it is. And it is the general rise in prices. So inflation, we're inflating, so it's got to go up. So prices are going up. And there's some good and bad to that because inflation can imply growth, but it's the rate of the inflation that is super, super important. Yeah. And so we want to explain how that is used on Wall Street because we use indicators on Wall Street like CPI, the Consumer Price Index, but that excludes the volatile price of food and energy, which are two things that everybody has to have every day to live life. So it's kind of weird that Wall Street excludes those two.
And a lot of times the most volatile when it comes to prices.
But it is an attempt to smooth out how volatile those can be because those can have the prices can move for reasons that have nothing to do with the overall economy. You know, they're like chickens. We just had a chicken bird flu and they had to eliminate a lot of chickens. And so that reduces the amount of chicken available and reduces the amount of eggs available. And so that price spikes on its own. So that's why those are excluded sometimes. And then the other thing is the producer price index, which is something that a lot of people on Main Street don't follow at all, but that's what businesses have to pay for their prices, for their goods to make.
And so inflation in terms of prices, right, is something that we live with and have lived with every day for decades on end. But over the last several decades, it really hasn't been a front of mind thought.
So it's about, again, the rate. So if you think since World War II, the number that everybody uses and has fixed in their head is 3%. Like, good times, bad times, whatever, the average is around 3%. The target for the Federal Reserve is 2%. So they would like prices to rise at about 2%. Why are these two numbers important? Because when we think logically about them, at 3%, prices will double about every 20 years.
Once a generation.
Once a generation. So eggs go from $1 to $2 in 20 years. So that's manageable. People can, if you're getting an increase in your pay of 2 to 3%, you can follow along with that. The Fed's target is, interestingly enough, 2%. And so at 2%, prices double every 35 years. So that means that if you're getting raises of 4 or 5%, you should be keeping ahead of the prices of goods that you need to survive. That's good for society.
And if you're investing for retirement, the market on average is outpacing inflation. So one day you're going to even be able to stop working. And so that's why that 2% number is such a big deal and very important when it comes to the Fed's target.
Right. So when we think about inflation, don't just think about the number. Think about the rate of change because And I'm just going to use simple numbers here. If something costs $1 and next year it costs $1.02, so a 2% rise.
Yeah.
The following year, it's up 2% on the $1.02.
Yeah.
It doesn't just go up 2% on the original dollar.
Right.
It has a compounding effect. And that's where things get wonky. And that is why there is so much discussion about the Federal Reserve and the direction of interest rates.
Yeah.
They manage interest rates, what the government is paying on your savings, to help bring down inflation or to even stimulate.
Yeah.
Maybe get people out there spending a little bit of money, buying something on credit.
Yeah.
I know your generation is doesn't like paying a 7% mortgage. Like, you guys think that's crazy.
Yeah.
My first mortgage was 9.5% in 1996. You know, so it's all about perspective of where you're coming from.
Absolutely, and I think that the mortgage example, when talking about inflation, is actually a pretty good segue when you're talking about going from Wall Street, setting rates. You know, where's the overnight rate? Where's the Fed funds rate? Where's mortgage rates? The 10-year, all that Wall Street kind of
jargon.
Yeah, jargon. But buying a home is kind of an everyman's job, right?
It's a Main Street experience.
That's a good way of putting it. Main Street experience. And so, what is Main Street inflation? I mean, we've kind of given the CPI, the PCE, all the year over year, month over month. Main Street inflation is, hey, last week I went to Kroger.
Yep.
Spent $100 and I had enough food for 2 weeks. And now I went to Kroger, I spent $100 and I had enough food for 4 days.
Right.
What happened?
Yeah.
I didn't buy anything different. I didn't go buy a TV instead of groceries. Everything was more expensive.
Yeah, and what happened on an accelerated basis is that coming out of COVID, we had supply chain disruption.
Yep.
We had the redirection of people spending. We literally were printing money.
Yep.
And sending checks to people's homes.
Yep.
Who really couldn't do anything except order stuff on Amazon.
Yeah.
Or have groceries delivered to their home.
Yeah.
Or fix their patio so that they could sit out on their back porch.
Yeah.
And there was just an explosion of demand. And so you have, inflation is simple. Too few dollars, too many dollars.
Yeah.
Too many dollars chasing too few goods.
Yep.
And the too few goods figure out quickly, I'm going to raise prices immediately. I remember the day we got sent home from COVID. This is relevant to the discussion. We had some people in the office that needed computers. We got on March 14th, we got on Best Buy, and they had slashed prices by 50, 60%. I bought 2 brand new computers for $250 each because Best Buy was petrified that nobody would have any money and they would be stuck with all this inventory. So they were afraid of too few dollars and too many goods. Well, fast forward 10 days, 10 days, and that same computer was priced at $2,500 because you had an ocean of money. Nobody lost their paycheck.
Yeah.
And you had paycheck protection and all these programs, and everybody, literally the world was working from home. Guess what you need when you work from home, Louis?
A laptop.
You need a computer.
It's useful.
It's useful.
It's useful.
And so that's inflation.
Yeah.
And so that's a silly example
to
literally what happened. So the rate of change was accelerated. And to your point, that manifested itself in 2021. 2022 is really when you started seeing the year over year. So it was happening in 2021, but it wasn't being reported until you got a year further out. And it was just crazy.
And so what happened then in 2022 was the Fed, to manage inflation, started to raise rates. And
dramatically.
Basically, all that means is when the Fed raises rates, they make the price to borrow money more expensive.
Right.
That's all it is. Whether you want to get a car, whether you want a personal loan, student loan, buy a house, whatever it is, that is what the Fed is doing when they raise rates.
The consumption of goods.
So now everything is more, it's expensive to get more money, and so it's harder to get more money. And so because it's harder to get more money, people have less money.
And that would then in turn cause a Best Buy or insert company here to try to lower their prices.
Yep.
To get you, to entice you to buy that good, whatever that good is. But keep in mind, one of the things we've said here is that, prices don't, once people get used to paying that price,
right,
companies get used to charging that price.
Yep.
And so that's where this big divergence of Main Street inflation versus Wall Street inflation. So you hear, oh, inflation's coming down. You're still going to the store. You're still spending $100. You're still only getting 4 days worth of food. And the world's out here talking about how inflation is coming down.
Yeah.
What they're essentially saying there, Louis, is you will be able to spend $100 on 4 days worth of food for a longer amount of time.
Yeah. Yeah.
Before $100 only buys you 3 days worth of food.
Yeah.
That's not comforting when I was buying 2 weeks worth of food 18 months ago.
That's right. No, it's really, really hard. And I think people got frustrated by it, especially in 2023, when you've seen the boom and bust of inflation. You've seen, hey, what's it like to have more money? And hey, what's it like to have everything more expensive? And
right.
in back-to-back years. And so in 2023 is when the reporting on that rate of inflation started to come down. So we were going from 9% year-over-year inflation to 8 to 7 to 6. So the rate of inflation was coming down. But again, you've still got a 7% increase from the year before. And to your point on doubling, that means everything's doubling every 10 years.
Right.
As opposed to 35 years.
Right.
And so that is just really tough to stomach and almost, frustrating when you're an everyday person saying, inflation's coming down. What are you talking about?
Well, what if you're on a fixed income? What if you're on a fixed income and you have a good job? Because keep in mind, during all of this, nobody's lost their job.
No.
People have lost their job.
But maybe you're retired and you're living off an annuity or a pension.
Right. Social Security. And here's the way those work. So even Social Security has a cost of living increase. Mm-hmm. Most employers will give raises based on a cost of living increase, which is based on not Main Street's indicator, Wall Street's indicator, CPI. So now your paycheck is going up maybe 3 to 5%. So let's qualify that. So you make $1,000 a week, or $1,000 a month, whatever it is.
Yeah.
And your paycheck's going up by, $30, but prices are going up $50.
Right.
That's a loser's game. You cannot win that. And in 2022, those prices, if you made $1,000, prices went up $90, and even and your boss may have even been like, "Hey, I get it, I understand. Like, this is tough. I've been giving you a raise of $30 a year. I'm going to give you a raise of $50."
Yeah,
you're still losing.
Still losing.
You're still losing. And the thing that's tough is those prices aren't coming down from that extra 90 down to the 30. Those prices are just going to go up by only 2% next year.
Yeah.
Or 3% next year.
Yeah.
So 90, right, is now 92.70.
Yeah. So I feel like we've touched on inflation a lot. I think, hey, and it's an increase in prices, and in general, prices don't come back down. They just go up slower.
Right.
And so what if the economy starts to slow and you have inflation?
Yeah, so that is something called stagflation. Stagflation is something that we have not experienced since the 70s.
Yeah.
So it's defined as an economy that is basically not growing or growing at a very slow rate. You've got a significant portion of the workforce that is unemployed and or losing their job in the midst of losing their job. And then prices for goods and services are moving higher at an accelerated rate. Again, that is defined as above the 2.5%. That is a bad deal. And
worst case scenario.
Right now, we don't have that. The piece that we still have is a full employment.
Yeah.
And employers are still sort of have in the back of their mind that we can't let people go at a fast clip because we may not be able to replace them. They still remember that from COVID where they let people go too fast and all of a sudden there was a shortage of people to hire, and then the employee gets to trade jobs to get raises. So stagflation is a bad place. We are not there.
No.
Inflation is actually moderating. That rate of change is moderating.
Yeah.
We have full unemployment, but we do have slowing economic growth. So we have one of the three pieces of that.
Yeah. So what if, so inflation, right, is the rise in prices. And that seems from a Main Street perspective, well, why can't prices just come down? Wouldn't that be good? Wouldn't that help me? And the short answer is no.
Right.
But can you talk a little bit about why not?
Yeah, so now you're talking about deflation.
Yeah.
Deflation is what the United States economy experienced in the 30s during the Great Depression. We experienced it a little bit after the great financial crisis, circa 2008 to 2013.
Yeah.
And so that's a period where the prices of goods and services decline.
Yeah, that sounds good.
It sounds good from the wallet.
Yep.
Right. I want to pay, in our earlier example, I want to pay $250 for that awesome computer.
Yeah. Heck yeah. What's wrong with it?
Yeah. The problem is that company can't sell that product at that lower rate and stay in business.
Yeah. So
when they go out of business, it all trickles, right? So they got to lay people off.
Yep.
They had 3 factories. Now they need 1. So that's what you saw with the automakers as demand for cars really slowed down in this domestic cars slowed down in this country. GM, Ford closed factories.
Yeah.
That's deflation. So that's high unemployment, low dollars available in the system.
Yeah.
Nobody buy. So now you're eating at home. Now you're having your car last 12 years instead of 4. You're having your iPhone last 5 years instead of 2.
Yeah.
Like you're pushing out things. That's the only way that prices come down.
Yeah.
And it is not good.
Yeah.
So you've seen countries like Japan who has had massive deflation for years. They literally cut their interest rates below 0 to stimulate people to. They wanted to discourage you from saving any money.
And to clarify, that is paying you to borrow money.
Right. I'm going to charge you like, hey, you give me $100, I'll give you 98 back. Well, in that situation, you're like, no, thank you. I'll just go buy something that I wanted to do or go a place that I wanted to go.
Right. And so really at its core, this whole inflation topic comes back to supply and demand. It is a simple, it can get really complicated, but it is a simple supply and demand equation. Hey, deflation, why is it bad? Because there's more goods that less people want. So the price comes down.
Right.
Less people want them because less people have money because less people have jobs.
Right.
That's bad. So the falling price is good, but the reason for it is bad. Just the opposite. Inflation is almost looked at as like a bad word. People really don't like the idea of inflation. We see in retirement planning, hey, what's inflation going to do during my retirement for the same reasons on living on a fixed income is really scary whenever you're dealing with high inflation. But inflation at its, core is good. It's healthy.
It's growing the economy.
Growing the economy.
And it's that rate of change we got to watch.
That's right. And so really, we'll kind of wrap it up with, hey, inflation at that 2 to 3% is healthy, and not just healthy, necessary for a growing economy that's growing at hopefully 5, 7, 10%.
Oh, that would be great.
So we hope you learned something about inflation. We hope you learned a little something from both of us on stagflation and deflation, and why those maybe aren't the happy answer that they may seem on the surface.
Thank you.
Thanks.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell, or solicitation of an offer to buy or sell any security or investment, or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company, Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company, Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.